Hello, accountants. So for some time now, we've had a very good discussion let me just put it like this, a series of very, very good discussions. We started in December. We learned a number of subjects as financial accounting, financial reporting, business economics. We have business statistics. We also registered for cost accounting, financial management, management accounting, and financial reporting, taxation as well. So a number of interesting subjects. We had a number of interesting discussions, a number of interesting subjects where we actually spoke about the details. We get to learn, we got to practice, and then we did everything that we could. So those sessions were all recorded and they were put in a particular folder. That means anybody can access them, including any new students, because we are starting for our June exams on Sunday, the 22nd of March. We are starting that journey again, and it's going to be interesting. It's going to be bigger. It's going to be better. For everybody who doesn't know me, my name is Ronald Kashweka, and this is what I do. So I was personally conducting those classes, and as you can see on this particular channel, I do a whole lot of talking, a whole lot of teaching, and a whole lot of explaining. Okay. All right, so today I want to talk about something that I believe is very special. It's special to me and it's special to any business because this is something that you need to know as a business person and also as someone who is literally studying accounting or just any other course. If you're studying marketing, purchasing and supply, that's still fine. Business administration, you still need to understand this. All right, so businesses make money, which is cash, and some businesses make profit. So there's actually a massive difference between the two. Okay. So then there's a situation where businesses might make profit, but not really have any money. Okay. Or businesses might have money, but not really have any profit. So that's the difference between um, a cash. That's the difference between profit and cash. The difference between profit and cash is that profit is profit is basically your ending balance after you compare your credit sales and your cash sales to all your business expenses. That's your cost of sales expenses and some other business expenses, and then you have your profit. But that does not necessarily represent the amount of cash that you have. Okay, so a business can be making profit, but does not have enough cash to cover their short-term liabilities or their long-term liabilities, meaning it will face liquidity issues and solvency issues. So one of the statements that we prepare, which is covered by International Accounting Standard number 7, for us to monitor our cash balances or our cash movements in our business is a statement of cash flow. So a cash flow statement or cash flow statements rather are one of the most failed topics in accounting. But today I'll make sure you get to understand it in a very, very simple way. Okay? So a cash flow statement shows how cash moves in and out of a business. Okay? It focuses on three main categories. That's the operations, investing, and financing. Okay? So let me list down the categories that you need to understand pertaining to a cash flow statement. The first one is operating activities. The second one is investing activities. The third one is financing activities. Okay, so it focuses on three main categories, or basically it categorizes our cash transactions into three main categories. That's operations, operating activities, investing activities, and financing activities. Right. Okay. So operating activities. Here we are talking about your business operations. Like what does your business do? If your business sells shoes, when you sell a shoe and you receive money, that's a cash inflow from operating activities. If you spend money on stationery or wages and salaries, that's also operating activities. Investing activities, here we are talking about non-current assets. and other investments. Okay, we are talking about non-current assets. So here we have the first one, operating activities. We are generally talking about operations. Okay, when we receive money in our business because we sold something that we are supposed to sell as our business. Okay, and when we pay out money because we've spent money on an expense that we're supposed to spend money on. Okay, that's all operating activities. Investing activities is on non-current assets and other investments. When you sell a non-current asset, that's a cash inflow from investing activities. When you purchase a non-current asset or you acquire a non-current asset, that's a cash outflow from investing activities. And then financing activities basically looks at where you are getting your money from. So every single time you see financing activities, what should come to your mind is equity and liabilities. Okay, so every single time you see financing activities, what should come to your mind is equity and liabilities. By equity, I'm basically talking about the part of the business that literally belongs to the owner of the business. When you talk about equity, we are talking about the equity elements, the equity share capital, the share premiums, the retained earnings. The other thing is the dividends. All that is equity. Okay. So I've listed some of them. We also under equity, we also have revaluation reserve. Under equity, we also have revaluation reserve. Okay. Under equity, we also have revaluation reserve account. So you have to make sure you are comfortable with them, but not necessarily for cash flow purposes, because for cash flow purposes, we are just focusing on cash flow, like the movement of money, the way money moves. So that means under equity, we'll look at our dividends. Let me give you an example. And our equity share capital. Let's say, for instance, you issue more shares, you issue shares. That's a cash inflow. Okay. If you issue shares, that's a cash inflow. If you pay out dividends, that's a cash outflow. Okay, under financing activities. Okay, so under liabilities, if you receive a loan, let's say for instance you get a loan from a bank, that's a cash inflow, financing activities. If you pay a loan, like a loan repayment, that's a cash outflow, financing activities. Okay, you just need to make sure you are comfortable with all that. All right. So basically, that's all the categories. And then there's one category that actually stands out, which is operating activities. So under operating activities, we have two methods that you can use. You can use either the direct method to prepare a cash flow statement or the indirect method. So the indirect method is the most common one, although the direct method also works. But during the exam, there's a high chance that if a cash flow question pops up, then it might be the indirect method. So the indirect method basically means you start with your net profit and then you adjust it for non-cash items. You start with your net profit, adjust it for non-cash items such as depreciation, okay, any profit on sale of a non-current asset. You adjust it for changes in working capital management, and then you have your net cash flow from uh, um, operating activities. So you always start with a net profit, adjust for non-cash items, adjust for working capital items. After you adjust for working capital items, then you have your operating activities, your net cash flow from operating activities. So our non-cash items, here we're talking about profits from disposal that was added as income but wasn't supposed to, depreciations, and apart from depreciations, we might have maybe some other things as well. And then working capital items, we're focusing on three main things. That's the inventories, the payables, and the receivables. So basically, you just have to monitor how they increase and how they decrease. Okay, so we're about to start a very exciting journey starting on the 22nd of March. Okay, where we'll get to learn about all this and even more in terms of accounting, that's taxation, business economics, business statistics, cost accounting, financial accounting, financial reporting, management accounting, you can name it. We have a number of interesting subjects that we'll get to learn, we'll get to practice, and the journey is going to start on the 22nd of March. Okay, So when we begin, we are going to learn even more, and then we're going to talk about the formats, and then we'll answer practical questions. When I talk about practical questions, I mean literally solving questions in an exam past paper. Okay, we'll literally solve questions in an exam past paper. We'll get to practice, we'll get to learn, and then we'll practice even some more the exam past paper. Okay, so if you'd like to join us, I'll put the details at the bottom. Um, I'll put the details at the bottom. Just email the emails that I'll put at the bottom, contact the numbers that I'll put at the bottom, and then you get to register. The cost is 400 kwacha every single month, and our sessions are every single time recorded, meaning you have access to the recordings every single time. Okay, you literally have access to free materials, the recordings, and everything you might need to actually clear your exam. If you're watching this, I would recommend you join as soon as possible so that we get to practice together. Otherwise, thank you very much. My name is Ronald Kashweka. Thank you.